The Federal Reserve System, the nation's central bank, has a dual mandate to pursue maximum employment and maintain price stability. These two priorities are currently treated equally, but that was not always the case. In fact, the Fed's bias toward maximum employment was a critical driver of the stagflation that plagued the U.S. in the late 1960s and 1970s. Recognizing the need to balance price stability and maximum employment, in 1977 Congress revised the Federal Reserve Act. The Federal Reserve Act was enacted in 1913 in response to the Panic of 1907. The act was revised in 1977 to direct the Fed to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. The 1977 revision of the act was important as it provided Chairman Paul Volcker with clear direction to end the Great Inflation. It also explains why the Fed must act decisively to reverse the persistent inflation that Americans are experiencing in the aftermath of the COVID pandemic. Why was the Fed mandate spelled out so explicitly in amending the Federal Reserve Act? Because inflation weakens economies and, if allowed to persist, has destabilized nations. The effects of inflation are especially insidious because inflation is a source of societal ills. Americans learned this painful lesson during the stagflation years of the 70s and after enduring a similar experience at the end of World War I and the Great Influenza. Inflation averaged more than 15% per year in 1919 and 1920. During these years, wages at many companies failed to keep pace with inflation, and labor strikes swept the nation. In some cases, strikes became violent, including this photo taken during the Pennsylvania steel strike of 1919. Federal government inaction gave state and local authorities and the steel companies room to maneuver. On September 23, 1919, according to newspaper accounts, Pennsylvania State Police clubbed picketers, dragged strikers from their homes, and jailed thousands. Strikes and civil unrest increased after the end of World War I and the Great Influenza in late 1918, and the inflation rate of more than 15% was a critical causal factor. Although the 8.2% inflation rate that we are experiencing today is much less than the inflation rate in 1919, it is still dangerous. Moreover, the painful experience of the Great Inflation in the late 1960s and 1970s taught policymakers that it is critical to stop high inflation before it becomes entrenched in the American psyche. The lessons of past inflation crises inspired the Congress to clarify the Fed's mandate in 1977, making it clear that maximum employment and price stability should be treated equally. In October 2022, inflation is clearly the greater danger, which means the Fed will continue to tighten monetary policy until inflation returns to its 2% target. This makes it highly likely that the U.S. will enter a recession in the near future, but such pain is necessary to ensure long-term economic prosperity. We are grateful to financial historian Mark J. Higgins for contributing to this video. His full financial history of the U.S., The Enlightened Investor, is expected to arrive in bookstores and online in fall 2023.